All right, we're live. Hello and welcome to wealthlessons.club, a podcast channel where we talk to entrepreneurs from all over the world and learn from them how they build and scale their business ventures. I have had the privilege of talking to many of European startup entrepreneurs, and I'm thrilled today to have with me one such serial entrepreneur, Joe Lewin from London, who is on a mission to do good for both the environment and startup community. He grew his last marketplace startup, Zwings, to 32 staff after winning multiple priced contracts. As the market was naturally consolidating with many mergers and acquisition deals taking place, it made sense to join forces with a competitor. Now, he is using his first hand experience of previously scaling a tech business from an idea on paper to exit to build Foundy, an end to end online marketplace for startup acquisitions. They are on a mission to completely modernize the process of selling a tech startup. They seamlessly connect startups to acquirers as well as the latest resources and advisors to help founders achieve the highest exit valuation. They specialize in both partial and full buyouts because they recognize that many startups are still years away from a full exit but have shareholders that want to take some chips off the table by liquidating a fraction of their equity. So this is going to be a thrilling conversation. I have been dabbling with angel investing for a while, and these are some of the questions that I have been battling too. And I'm looking forward to this conversation. So, with that, let's welcome Joe. Joe, welcome to wealthlessons.club. How are you doing today?
Thank you for the kind introduction, Ravi. Really appreciate it. Yeah, very well, thank you. How are you?
Had a long day, but I'm all pumped up to have this conversation with you.
Amazing.
So let's get started. So why don't we, before we set the context of this conversation, why don't we get to know a bit about yourself, about your career trajectory, your formative years towards entrepreneurship.
Cool, 100%. Brilliant. So before starting Foundy, I built a company called Zwings. It is a e-scooter and bike sharing marketplace, an app-based mobility company. You've probably ridden the e-scooters and bikes, whether in London or Paris or Barcelona. And I saw the trend for this form of mobility come over from the US. And after having ridden a bus for an hour every day, twice a day, just to travel 3 miles, I thought this was just completely insane. Whilst I respect public transport a lot, I just knew that it had to be completely modernized with a faster, more convenient alternative. So e-scooters, I believe, were the future. This was back in 2018. And it grew from there. But really, I think entrepreneurship has been something brewing, I think, in the back of my mind ever since probably at the beginning of university. Didn't really want to go into the corporate world as much as I respect those that do. So I think I was destined to start and scale businesses for a living.
Usually, people who venture into entrepreneurship right at the outset, straight away from college, they are influenced either by their own network, by the
Mhm.
community. So, what were your influences early on to take this leap?
Yeah, sure. So um, I think there are a lot of success stories that inspired me. Of course, Elon Musk, Richard Branson, a British entrepreneur, and a few others. And in fact, I did an internship with a gentleman named James who founded a teaching platform where it was an online tutoring. And I remember going to the office, and they were in a shared workspace. And it was amazing. I sat between the two founders when they were very early stage, barely generating any revenue at the time. And they were just telling me about the unlimited rewards that entrepreneurship can bring. And I was just absolutely inspired. And now, fast forward, the company is doing incredibly well. I think they have over 5,000 employees,
Wow.
including all of the teachers that they have on the platform.
Wow.
and offices around the world. And he was Forbes 30 under 30. So real inspiration for me from an early stage. I think I was about 20 at the time, but yeah. And then I think um, an idea came to mind for both Foundy or Zwings through just personal challenges that I wanted to overcome, and in turn help others get through those processes more efficiently.
Got it. And did you have a set of mentors because this was your first business? Like, how did you prepare yourself for this uncertain territory?
For sure. And I think there's a degree of naivety going into entrepreneurship. Starting a business involves a lot of risks. And really, if any entrepreneur knew what they were from a calculated perspective, they may well not get into entrepreneurship to start with. Mentors, I didn't really have that many in the world of startups. No one in my immediate vicinity, friendship, family really got into entrepreneurship. So it was kind of a lot of learning on the job to start with, but built quite a nice network, and have since made friends turned mentors. Some were angel investors in the company, others were eventually non-exec directors who've been incredibly helpful. I'm eternally grateful for them providing their support. But yeah, learning from mentors from an early stage is really important, I think. So with Foundy, we've got various advisors and mentors on board from an early stage, just to avoid mistakes, learn from their mistakes, and consequently we can grow faster, more efficiently. Um, yeah.
But in 2018, were there already? I'm not very sure when did this entire movement towards e-scooters began. How was 2018 landscape then? Was it as crowded as it today?
Um, it wasn't, no. And there were success stories where one of our competitors at the time was like the fastest company to reach $1 billion valuation or something. It took them 6 months. So those are the kind of success stories that really inspire you a little bit. There were some competitors, but then obviously more popped up as and when the market was evolving, and that's pretty standard. When something is proven and validated, naturally there's going to be more and more competitors pop up. So
Got it. So how did you set about like did you have to raise money to begin with? Did you pull in your own money? You talked about angels. Maybe a bit about your starting capital.
yeah, I mean, I didn't really have much savings at the time. I kind of put everything I had, really. When I say everything, I mean absolutely everything I had to the business, and then couldn't really afford rent. So I think I was like staying with my brother for a bit, and then he made me go live with my sister. So um, started really from minimal capital, but I think with the internet and available resources online, there's plenty of scope to start ideas from scratch with minimal capital. But with Zwings, given that it's a heavily asset-based business, you have to
Yep.
buy the scooters in order to
Yep.
generate revenue, and these
Yes.
scooters are very expensive. Nowadays, they're about €800 or something for these sharing scooters. So there had to be capital. We raised from angels once we had a bit of traction. Once we had that, um, once we had proven that we could be a real business and we could generate revenue. So it's pretty scary though, taking on external investment, because you are then responsible for other people's money, and they've
Correct.
worked really hard to raise that money, or at least if it's an angel, they may have had a corporate salary for X number of years and they put away savings. They're now putting that into you. Or if it's a VC, it's the same. It's just lots of limited partners that are putting money together. So a lot of responsibility when you take on external investment. So it's not essential. I don't think founders should just take on funding for the sake of it. But it's definitely necessary with Zwings to catapult our growth. So
Got it. And how long was the journey with Zwings? How many years?
almost 4 years from the very beginning, but learned a lot during the process, from everything from hiring, managing a team, through to operational management, all of the various tools and platforms to use to communicate, to coordinate suppliers. A lot of lessons came out, both professionally and personally. I think as a person, as a leader. So
So there was the hardware aspect of it and the software aspect of it, right?
yeah,
So
yeah.
um, very few people know how to manage hardware. I
Hmm.
mean, we are all talking about software tech, but hardware manufacturing, is it something? I mean, how hard it is? Like, did you do everything from scratch, or did you? What was the supply chain like? How did you assemble? Did you have a factory? Maybe a bit about that as well.
I think the coordination between suppliers is a very complex matter. Um, in order to get parts over, forecasting parts, then the time at which it takes not just to order it, but then to get it across. So there were 2 to 3 month wait times to get parts across. So from the factory, so it was a really complex, but teaches you a lot about supply chain management, warehouse management, organizing, coordinating parts, working out what's needed. Um, so yeah, that was a lesson within the area of logistics and supply chain. Um, Foundy is an asset light business in stark contrast. We're website based basically, and we're facilitating the sale of companies, whereas Zwings was a marketplace, yes, but we had expensive vehicles, hardware that interestingly would sit on street corners in order to be rented to generate revenue, yes, but at the same time there was daily depreciation, weather was a different variable, theft, of course, although it wasn't extreme. Theft is also something to consider with your assets. So um, learned a lot in that respect, and a lot of risk management going around that.
Why do you call Zwings a marketplace? Was it a marketplace in real
Yeah,
terms?
yeah. I mean, it's a marketplace to the extent that it's an app where you can log in to access readily available vehicles, a
Got it.
product, or, which is also a service, and then you pay a fee in order to access that
Got
service,
it.
which is um, yeah, it might well involve hardware, and it's not necessarily a website based business, but it is a marketplace, and there's a community that goes around that. We have about 80,000 customers now. A lot of people who are using the service daily for commuting. So
Wow.
um, yeah,
80,000
it's
is a
really
lot. Why don't you quickly, before we jump into Foundy, I'm very curious to know your growth trajectory in those 4 years. Like, how did you start? What was the growth trajectory, and where did it all end?
Yeah, sure. So what's interesting is that Zwing started as a B2B micromobility company. So we were serving hotels and offices with bikes, app-based but private fleets, to help their employees or help their guests travel to and from various facilities in a sustainable, affordable, convenient manner. And that was all going well. And then the pandemic hit, and goodness me, that was a not a very nice time, I think, for a B2B hotel and office transport solution provider. As you can imagine, probably the worst space to be in, or one of, because I know that a lot of industries were very negatively affected. But it wasn't good for us. It wasn't good for many businesses and industries at the time, hospitality included. So what we did was I moved back in with my parents, of which they weren't so happy about, but it was yeah, as you can imagine, but sharply pivoted the strategy, and we moved from a B2B company to a what I describe as a B2GC company, business to government, and then to the city. So we pivoted, joined an accelerator program, went through a very detailed 4-stage interview due diligence process, basically, that with really intense questions in order to get onto an accelerator for mobility. I think it was one of leading mobility accelerators, and about 130 companies applied, and I think about 10 get in.
Right.
So it was quite intense, but we got on, and all of a sudden our growth just exploded. We went from one person because we had a team, and unfortunately we had to make them redundant
Right.
because our revenue went to zero. And then we grew from 1 to 32 people, and I think 8 months or something.
Mm.
It was exciting. Then we onboarded investors who I'm eternally grateful for, because they backed us, had confidence in what we're doing, and we grew. We won lots of contracts with various cities. Then we deployed these e-scooters, and actually, in some ironic fashion, that the the social distancing aspect of scooters actually proved beneficial.
Hmm.
So it was a sustainable solution, but also for social distancing purpose, people commuting and not using public transport at the time. So a lot of people relied on us during that period of time. So it was quite intense, quite stressful, but really quite fulfilling.
And where did it all end? You talked about bagging multiple priced contracts,
Yep.
and then are you still running the business, or where did it all?
Yeah, so we're actually just very close to closing up the acquisition process. There's natural market consolidation within a lot of industries. When there's quite a few competitors, they naturally just merge with one another or acquire. And for us, we had quite a few bidders that were interested in acquiring Zwings, and it just made sense to follow through with that process. And consequently, um, we we went with one particular bidder or who's a competitor who we have reasonable confidence in actually in terms of their growth in the market. They've raised quite a nice funding round recently, so that's quite exciting. So we're going to come together with them. We can hopefully take over parts of Europe with e-scooters.
Lovely, lovely. And then a new idea germinated in your mind
Yeah,
called Foundy, and as I mentioned, it is an end-to-end online marketplace for startup acquisitions. And this is something that I've always been curious about entrepreneurs who are serial entrepreneurs, because at any given point of time, especially after gaining expertise and experience in entrepreneurship, there will be 100 ideas in your mind, right? So how did you, out of all the ideas that you wanted to do next, how did this idea came up? What was the trigger? What was that one thing that led you to jump to take this leap?
100%. So ultimately, I wanted to find something that I was deeply passionate about because I learned with Zwings, and any founder would tell you this, like you need to have incredible passion um, beyond any kind of monetary reward or anything. You have to have incredible passion for the idea that you're working on because ultimately it requires a serious amount of hours, night and day, for potentially years and years on end. So I needed to find something that I genuinely felt like I could be working towards solving a problem for a given market niche or a community. And the idea was sitting underneath my nose. It was the M&A marketplace. I needed to solve this ancient problem of selling a company. It was unbelievable, the stress, the unnecessary complexity and inefficiency of selling a company was unbelievable. We had multiple bidders from different countries, different legal systems, each with various clauses and terms and timelines. And it was honestly, it's not this glamorized experience or process which you might assume it might be after you've built a good business. When it's not at all, and actually it can take up to 12 months or more just setting the company.
Wow.
So I needed to solve that. There were other ideas, sure, that kind of were on my mind, but this was by far the one that I knew I had to tackle. And that passion is so strong still to this day, and been building it for quite a few months now. And I think the process of selling a company, modernizing that, connecting buyers and sellers, yes, giving the support infrastructure that they need, also very important. But actually, personally, when it comes to actually selling someone else's company and seeing their faces light up from like $1 million to $10 million in their bank account from an acquisition that you facilitate the connection with and you supported from start to finish, for me, I couldn't think of anything more fulfilling. Couldn't think of anything more because they can use that money for their friends, their family. They may well have been living off a tiny salary for the last few years, and this is genuinely life changing. So that is really what drives me. I want to help founders and buyers facilitate mutually rewarding deals and hopefully positively change someone's life.
Got it. So it all started with your own personal experience of trying to
Yeah.
sell yours. Uh,
Yes.
but how did you validate that this is not just your problem?
Yeah.
but problem of a lot of other entrepreneurs as well. Like,
Yeah.
did you start talking to people, or how is it?
Yeah, great question. So ultimately, yeah, you need to ensure that there is a market need. One of the number one reasons businesses fail, unfortunately, is just a lack of market need. There's no one wants to buy your product or service at a given price. The second one is obviously running out of cash. The market needed to be validated so that I wouldn't commit the next 4 or 5 years of my life and a lot of money and risks to something that actually nobody really wants. I spoke to investors, I spoke to buyers, I spoke to founders, many of them. I think over 100 eventually, with questionnaires and interviews. And I just wanted to ask them honestly, is there a need for an end-to-end marketplace for startup acquisitions? And a lot of founders who've actually built and sold businesses, including our investors, like were so convicted by the need for this platform. In fact, our VC was literally on a mission to find a company building a European-based marketplace for startup acquisitions. And then I messaged one of them, and we've built an incredible working relationship since. They've been very helpful in supporting and Foundy with a very large pre-seed check, but also just on hand as well. But they, like me, they're using their experience in building and selling companies to build Foundy. There's a lot of overwhelming amount of need basically for what we're doing. So it seems.
Got it. So help me understand. So if you're running a startup, at what stage, what kind of startups are you targeting? What is the sweet spot? Because eventually a startup could go at different stages of growth, right? So you could go all the way, I mean, you are successful, you can go all the way till IPO and not sell yourself. But at
Yeah.
what stage would an entrepreneur want to sell his business off? Because this sounds a little counterintuitive to me. uh, Building instead of selling, right? So could
Mhm.
you shed some light there?
Yeah, sure. I'll start by saying that there's a startup is 16 times more likely to get acquired than IPO. A lot of success stories you see in the news where they hit the Nasdaq bell or the London Stock Exchange and they're celebrating those balloons. That's amazing and honestly, genuinely inspiring for Foundy and our investors, sure. But actually, 95% of companies are valued less than 30 million pounds, and a lot of the founders don't necessarily want to adopt this Silicon Valley mantra where it's build a unicorn or die, kind of grow at ridiculous pace, which is unsustainable. Um, I think particularly now with the economic downturn, people are being a bit more conservative. And actually, a lot of founders, particularly bootstrap founders that haven't taken on external funding, are very comfortable doing 500,000 ARR or maybe 3 or 4 million ARR. They've got a great income. It's relatively stable. It's likely higher than what they're earning at their job back at a corporate company. And then when it comes to exiting, they might want to facilitate an acquisition and be very happy with a 500,000, 1 million, 2 million exit. So because it's life changing. I mean, it's many years of the equivalent in a corporate salary. Yet you've only spent 3 years building the company. So
Hmm.
who wouldn't be happy with a $2-3 million exit? But my point there is the support infrastructure with the M&A industry at the moment is just not set up at all to serve these smaller businesses. I can't place enough emphasis upon that. When like if anyone's at the desktop listening to this, type into Google M&A advisor startup. Now you will be inundated with results, pages after pages of traditional brokers, advisors, and experts. And I have no doubt they are, and they've got a lot of experience. But where do you start? There's so many different advisors, so many different experts. It's hard to know. And actually, when you eventually find out their pricing, once you have a call with them and they set it, as to whether it's fixed, I don't know. But what you'll find is that you're leaning on them a lot to answer questions. And when you're running an M&A process, I can assure you there's a lot of questions that you'll be wanting to ask, particularly if this is the first company you're selling. We Foundy wish to empower founders and buyers to be able to successfully navigate an M&A process without having to constantly rely on external advisors, including lawyers. And everyone knows how expensive lawyers are. So if there's, you're working with the associate, but the partner's there helping out, you're getting charged £250 for the associate, then £400 an hour for the partner. So for the kind of smaller startups that I'm describing here, the 95% of companies out there, it's just not. It's difficult to warrant those costs. If you're paying 60 grand for the lawyers, accountants, advisors, and the company's only selling for 600-700 grand, it's quite a lot to really warrant. So for us, we want to be able to give founders and buyers the resources, blogs, tutorials, podcasts with people who have built and sold businesses, allow them to learn, be educated on how to successfully navigate the process. We'll have a detailed FAQ, which has, I think, about 60 questions and answers in there at the moment about the process and how they can navigate it. So in turn, they can go as far as reasonably possible independently running the M&A process. Some won't need to use advisors. I'd probably recommend using a lawyer, particularly for slightly larger exits, for legal matters for sure. But there's a lot of founders that will want to independently do this. And we want to serve this community, these bootstrap founders, these seed stage founders, pre-Series A. Average we might find would be doing 20K RR all the way up to 300K MRR, sorry, 20K a month to 300K a month in revenues.
Got it. Very, very exciting. What is the status quo today? Where do startups look out for information when they are looking for an exit, or acquirers looking to buy startups? What is the status quo today? Maybe around Europe.
Yeah, in Europe there isn't any marketplace operating at scale as of yet. No one with significant VC backing. It's an early stage market. It's a validated niche because the US is a slightly more mature market than Europe, and there are some great companies out there that have really proven the model, and we have respect for those. But in Europe, there's no one operating at scale. We've raised, I think by far, so I know, with information as we have now, the largest round, about 1.5 million euros pre-seed. Which I'm very, very appreciative of, but I think that helps to accelerate our growth. And hopefully, with our team working together, we can emerge as a significant player, if not the lead player here in Europe, serving European companies, yes, but also there's going to be a lot of Australian companies. I think I've spoken to about 5 founders between Melbourne and Sydney, as well as a lot of American and Canadian companies too. And yeah, but I think there's plenty of opportunity here in Europe. I think there's plenty of opportunity. We've identified about 1.2 million companies out of about 25 that would actually pass through our vetting process. We only need to facilitate about less than 1% of those to really make it to get to a really, really attractive valuation as a company. But there's advisors out there. There's traditional brokers, as I mentioned before. There's a few players over in the US. But really, you're otherwise relying on YouTube, random blogs that you read. We want everything in one place. Foundy is going to bring that all in one place.
I see massive potential here, and I want to draw a parallel with how you buy and sell real estate.
Yeah,
And
good
that's
analogy.
exactly, yeah, and that's where, also because of lack of transparency and knowledge, both the buyer and seller suffer from this lack of transparency.
Yeah,
So they go to real estate agents, realtors, and usually the way realtors stand out is whoever is able to create an impression of trustworthiness, that they would get the best valuation of
yeah.
their property. And valuation is important. Like, so how are you creating a trustworthy and transparent valuation for these startups?
Yeah, it's a really good comparison, Ravi. I appreciate you you mentioning the property space because they've really proven the need for marketplace, an online marketplace, I should say, to not replace but to complement or build on the existing high street broker, kind of the traditional real estate agent. Both have a need for sure. A lot of people like that in-person experience, but Rightmove, for example, or Zillow.com have really proven the incredible opportunity with an online marketplace. So that analogy makes sense. Connecting buyers, sellers to one another, but then also having the resources and blogs, particularly around first-time buyers. There's a lot of confusion and complexity around buying property, first-time buyer, and that Rightmove are doing an incredible job in helping that, and they've proven themselves. I think they do about 300 million in revenue and about 66% net profit margin. So goes to show that the need for marketplaces. There's other comparisons where we've seen industries modernize with marketplaces. Airbnb, Kazoo, eBay. The traditional alternatives would be selling in person. If you wanted to rent out your house, you might do it on kind of traditional broker style website, or have a high street shop or something at great cost. So why is M&A stuck in the past? Why isn't there marketplace, online marketplace, as you have with selling a car, selling a house, selling furniture? Why don't we have that with selling your company? Surely, when it comes to you're selling a company, something you've worked on for 3 to 4 years,
Right.
you want to be able to have empowerment to independently run a process as far as possible. So that's why that's why I really want to solve this for others.
So as seamless as buying and selling stocks, isn't it? So
Yeah.
but how are you solving this? Because as you said, there is a lot that happens in an M&A deal. There is this valuation piece, which is always a guessing game, but nobody has cracked it. But still, you want to come up with a fair valuation. How are you solving all of these pieces? Maybe some guidelines there.
Yeah, sure. So I ought to address the evaluation piece. So the support around selling a company is really important. Likewise, on the buy side, I'll address sellers though. So setting your valuation initially is really important to get that right. Now, the multiples, unfortunately, are coming down with the economic downturn. So there's a lot of buyers out there looking to buy companies. They see opportunity with the downturn to get kind of better pricing.
Right.
We hope that if we build up a massive buyer network, that will help to maintain competitive tension, because that's one of the best ways to ensure you get the best valuation for your startup. As many bidders basically as possible. If you've got 25 buyers bidding to buy you, the whole average industry multiple goes out the window to a large extent, because you've got that many people wanting to acquire a company. That comes from critical mass, network effects, getting as many buyers on there as possible. Now, when it comes to valuations of the average company that might not have 25 bidders, we're looking at industry multiples, and we can help guide startups in that regard relative to SaaS or e-commerce or Web3, whatever we feel is the industry average, what we're seeing elsewhere in the market in terms of acquisitions, and we can guide accordingly. But we're not we're obviously not saying you can they have to do kind of their own independent search, because obviously we're not regulated yet. But of course, we can show data of what appropriate valuations are. We don't want people overpricing themselves, because we're a multi-sided marketplace. We want to have realistic valuation, but at the same time, we want sellers to get as much at the biggest payout possibly to reward them for their hard work.
Got it. So when you have raised 1.5 million, where is it? Like, is this has tech got anything to do with this, or it is primarily a process and workflow and M&A? So is this a tech play at all?
Yeah, I mean, fundamentally, we are a computer software company through and through. So the capital is being used to build the technology, yes, but once fully built, which it is now, which is amazing. We're launching literally this week, actually, which is exciting. But it's being used to build the team, the tech department, yes, and then also on the account management and sales side. We have the benefit of having a lot of inbound. So whilst there is cold outreach, business development, we have the benefit of having quite a few more startups applying to list than we actually approve to go live on the platform. which is nice. Inbound sales or leads. It's always nice to have, I think.
Got it. I'm also envisioning that this opens opportunities for new entrepreneurs who never ventured into entrepreneurship,
Yeah,
because
£100%.
you're sort of democratizing it. You're giving access to information and knowledge,
Yeah,
wherein it was always a privilege of the few who had knowledge and information, getting these deals and startups. So, do you see that opening up as well? Like lots of new entrepreneurs, instead of building their own startups, they could see if there are promising startups where they could actually buy a running business and help them grow.
very well said, Rafi. I think you sold that better than me. That was really cool. Democratizing the ability to buy and sell startups is exactly what we wish to do. We want to aspire entrepreneurs. They may well be a student coming out of university, or they may well be 60 and feeling that they're going towards the end of their career, but they want to do something for themselves. They want to work um, when they want, for themselves and their family. So it's a very broad market, but there's a lot of aspiring entrepreneurs. We want to give access to great startups with proven suppliers, customers, brands, but they may be selling for about £40,000, and consequently that makes it a bit more affordable for people to buy. As opposed to the companies you often read about in TechCrunch, which sell for 50, 100, 200 million pounds. I think MailChimp was recently acquired for 12 billion. So it's obviously these are great to read about, but in reality, it's not accessible to the masses of people. But instead, there are a lot of great startups, a lot of SaaS companies, e-commerce companies that have sales. They've already found the suppliers. They've ironed out all of the issues. They've mitigated the risks through various measures. Why start a company from scratch? Probably pay the same £50,000 or so to get it up and running, when you could just acquire an existing company that has all of that validation and they've ironed out all of the issues. And you could actually probably hire the original founder if they wish to stay on to run the company, and you could just be the owner. Up to you. But there's that flexibility. Just going to move around. There we go. Yeah.
What are the other forms? So there are multiple forms. It could be a whole buyout, okay, complete full acquisition.
Yeah.
And what are the other forms? Like there are partial buyouts as well, isn't it?
Yep. 100%. So there is a growing phenomenon for secondary share sales. A lot of investors that I speak to are increasingly allowing their startups or their startup founders to sell a fraction of their equity in order to liquidate some of their paper value or paper net worth into cash. Now, one of the main reasons for that is because actually there's a lot of stress on founders, given that they make the assumption that they will eventually be acquired, the whole company, in X number of years, maybe 4, maybe 7, it could be 10 years, but there's no guarantee of that. Now, if you have a net worth on paper of £5 million, you've built a great startup and you've had investors come in at a certain valuation to prove that. That's great, but you may well only be paying yourself a £35,000 salary, and you've got family to feed, and you wish to pay off a mortgage or something or other. At the moment, really, a lot of founders feel obliged to just continue their pathway, and hopefully there's a great exit for X number of million in so many years, but that may never come for one reason or another. Secondary share sales allow you to liquidate some of your stock into cash and hopefully take some risk off the table, but also just relieve stress. And then in turn, the founder can renew their focus on the long-term growth of the business and may not actually choose to sell the whole company so soon, because the alternative is, I'm really stressed at home with financial challenges. Let's just sell the company in 1 year. Instead, secondary share sale now, sell 10% of your 40% stake, renew your focus, take a holiday, do what you need to do, and get back to focusing on taking that company 5x and then selling in 3 years' time instead. Secondaries are very popular, but also I wish to accommodate for the millions of employees out there at startups and bigger companies that have options. Now, when you go to hire employees, you often show that, there's equity opportunities. great, and that's amazing. You hope that it will grow into something, but in reality, a lot of employees never get to see the cash from all of their hard work and fueling that growth. I want to be able to start a trend, and it's in its early stage, but I want to get there where startups allow their employees to exercise their options and turn that into cash. It may well be at a discounted valuation, but I want to be able to help startups do that for their employees. Let's say they've worked for 3 years, they've hit a threshold, and they're able to liquidate some of their equity just to reward them for the hard work. Otherwise, they feel obliged to stay until the IPO. That may never come. It may be in so many years. So again, secondaries are really good for selling selected investors that might want to turn their equity into cash. Founders selling some of their stock, but not all of it. And then, of course, employees, again, selling some of their equity. So yeah, I think secondary is a big one. Partial
That
sales, full sales. If you want to sell the whole thing, for sure, that's where Foundy's platform is, ready to sell the whole company. So there's buyers
excellent.
out there wanting to do both. So
I think this was the meatiest bit because I am dabbling, as I said,
yeah,
as an angel investor, and
cool.
to have the patience for like 7 8 years is way too long.
Yeah.
So is secondary becoming very popular nowadays, or how is it?
Yes. Yeah.
Okay.
Yeah. So I speak to a lot of VCs that are allowing their founders to undertake secondary share sales. So often or not, it happens at funding rounds. So you might do a pre-seed Series C, Series A. At the C to Series A, you might see that founders begin to convert. If we do £1 million raise or something, might take 50, 100k, 150k off the table. Really depends on the investors and their appetite, but in certain scenarios, yeah, they allow that. Angel rounds and kind of smaller companies, it's less common for sure. But secondaries, I think, have become increasingly common.
Excellent. And have you gone gone with your angel round already? Like it's a VC conversations now, or how is it? Like people will be thrilled to have this opportunity to invest as an angel in your company as well, isn't it?
Yeah, for sure. And we only set out to raise about £500,000. I know I'm switching between different currencies on this call, but £500,000. And actually, we ended up raising £1.25 million, €1.5 million,
Wow.
which is yeah, I'm really appreciative because it was a lot more than we were initially anticipating. But it does mean that with the help of VC and some entrepreneurs that have turned into founders, they've built a business into kind of a multi-100 million pound exit. I can use their experience, their knowledge, and the capital to really accelerate growth with Foundy. So yes, I'm open to working with angels. I think they're incredible. Adaptability, using their experience, whether they're in corporate or startup world. There's a lot of yeah. I like working with people. I like working with active investors that want to get involved and suggest ideas. So we're going to raise, I think, a bit more capital because we're getting quite a bit of interest. So yeah, the plan is to kind of probably just top up our pre-seed at the moment, but we've got a really strong runway. So yeah,
Excellent. I know you're solving a massive problem, and I don't see any reasons why this should not be a stupendous success. So, all the best to you, Joe, and looking forward to your growth story. And thank you again for talking to us and explaining and taking us through this entire journey. Much
thank
appreciated.
you, thank you, Ravi. I appreciate it. Thank you so much for having me on.
All right. See you around. Bye bye.